It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. We are delighted that you're spending some of your weekend with us. It's Jill on Money. We are broadcasting from the Capital One studios. Capital One, what's in your wallet? Yeah. Okay. It's, what is it? It's the winter doldrums. People are kind of like, I don't know. I think people got cabin fever all over the place. The good news is that with everyone doing their taxes, they're definitely hyper-focused on their money as well and their investments and their planning, which is fantastic. If you've got a financial question, we'd love to hear from you. Our email address is askjill@jillonmoney.com. It's askjill@jillonmoney.com. So let us start the program with a question, and this is from a listener. Sarah is in the Great Pacific Northwest. Hello, Sarah. Welcome to the program. What can I do for you?
Hi, Jill. Thanks. My husband and I have 401ks that are each just over $1 million. I'm 59 and a half, and he'll be 58 in October. And we'd like to retire, but first we'd like to pay off some mortgages and other bills, and we need to know what we should do to access our 401ks properly and what the stipulations are.
Hold on a second. What are you going to do with yourselves? You're young. You're healthy. You've got a long retirement ahead of you, right? You're going to, God willing, you'll have 30 years. So what's prompting this, just out of curiosity?
Well, we've each been there well over 30 years. It's time.
Okay. Will you be entitled to any pension income?
Yes, it's not great, but about $3,000 a month.
Each?
Yes.
Okay, so $6,000 a month will be coming in. Will that happen right at retirement, or do you need to wait until, is there a trigger for that age-wise?
No, 59 and a half.
Mm-hmm. Right at retirement.
No, is it right at retirement? That's Ken. That's my husband.
Hey, Ken.
Hello.
And so that'll happen then. I mean, we have to wait a month for it to kick in, but that's nothing.
Okay, so how would your life be with $6,000 a month? Could you live on that?
Well, not and pay off our mortgages.
Well, who said you're paying off your mortgages? That's what you said you wanted to do. Right now, could you live on currently, like your current expenses, mortgage in place, could you actually pay your bills on $6,000 a month?
We could probably could do it, but it'd be probably very, very tight.
Okay. So ideally, what's the amount of money that you guys really would be comfortable with? If it's not $6,000 a month, tell me what the number is.
Probably around $8,000.
Okay. Fantastic. So that means likely that as long as we can get you from 59 and a half or 58 up until, let's say, I don't know, 65, that you guys will then have some Social Security. If we can just fund the gap, right, then the Social Security will give you, on top of the pension, should be able to pay for what you need. Is that fair?
Yes.
Okay, great. Now, what about money outside of those couple $1 million in the retirement accounts? Do you have any savings accounts or investment accounts that are non-retirement?
Well, we have, kind of like a house account that we have, that it's probably got about $15,000 in it. Mm-hmm. And beyond that, that's probably about it.
Okay, now let's talk about
we've got some other little minor savings that,
not much to speak of.
Okay, so we would say that mostly you got the money that's in the retirement accounts. Okay,
right.
Now here's my question to you. What is the house worth right now?
Probably about $650,000.
Okay. How much of the mortgage? What's the outstanding balance on the mortgage?
Oh, probably about $225,000.
Okay.
And we have two of them. So what's the other one worth?
Two houses.
Yes.
Yes.
Okay. So house one, 650, 225. What's the interest rate on the primary?
3.25%.
Oh my God, it's so cheap. Okay. Second home, what's that worth? Is it rental property or vacation property?
No, it's just next door.
It's just a house we have. It was our first original house that we bought.
And we're remodeling
And
it.
we're in the model of a major.
Yeah, we've
major.
added on half a house.
Wait a minute.
No.
Wait a second. I got to understand this. So you've got two houses next door to each other because you want to build some sort of family compound, or what? What's the game plan here?
Oh, actually, we bought the house next door because the gentleman passed away, and we thought, that would make a fantastic glass blowing studio.
Uh-huh.
And my husband blows glass. Excuse me.
Fantastic.
Mm-hmm.
Okay, so are you going to sell house number one? Like, what's going to
No.
happen?
We're going to live in house number
We'd
one.
like to go back to house number one.
Yeah, we'll live in house number one.
It's got a home equity line of credit outstanding on it.
Okay. So what are you going to do here? You're just going to keep them both?
Well, it's a gorgeous bunch
At
of
the
properties.
moment,
Yeah,
Oh
we
my
are.
God, you guys are something else. Okay, so the second home is worth how much?
Well, they're both comparable. They're both
So
probably
same
worth,
650.
Yes.
Okay, and what's and you've got a home equity loan for the renovation? Is it against the second property, or was that
Yes.
included? Okay, what's the home equity loan for that?
It's about $118,000.
Okay, and that's priced at what? What's your benchmark for the home equity loan? Is it variable or is it a fixed rate?
No, it's variable.
And so you're paying peanuts right now, right?
Yes.
Okay.
I've been paying, some extra on it here and there. You know what I mean? Because it's
Stop doing that.
oh,
Stop paying. Okay. I see two issues right now. Okay. The issues are that, right now, you guys, how much are you going to earn this year in income together?
well, if we don't retire, we both keep our jobs. It'll probably be around about 180,000
Okay.
between the two of us.
Yep. Here's what I see as your issue. The issue is you don't have a ton of liquidity, right? You've got these two houses. You got $1.3 million in real estate, which is, you got $340,000 or so of mortgage against that. That's not a big deal. That's actually a fine ratio. But, oddly enough, for people who make as much as you do, and for kind of where you are in your life, you don't have a lot of money outside of these retirement accounts. So now the question is, what are we going to do to get you there? Guess what? This is called the ultimate tease. I'm going to make you wait because we got to go pay some bills. And when we come back from our break, we're going to talk about what the options are and how you might want to think about what this near-term, intermediate, and long-term retirement plan should be. How's that? I think that'll make sense. All right, you're listening to Jill on Money, and if you've got a financial question, just give us a holler. Our email address is askjill@jillonmoney.com. And maybe during the break, what you want to do is go to the website, jillonmoney.com. Sign up for our free weekly newsletter. It is free, and it is worth it. Okay, we'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money. Before we went to the break, we were talking to Sara and Ken, who are from the Great Pacific Northwest. And we're talking about what I'd like to call early retirement, because Sara and Ken are not even 60 yet. So now you guys are listening to me, and I'm like, it's funny. During the break, I said to Mark, I'm very worried about this plan. It's not a worrisome plan, because I am going to tell you that really what's bleeding through is my fear of people retiring slightly early. So here's the situation. If, guys, you're just listening and joining us, Sara and Ken, they're in their late 50s. They got about $2 million together in their 401ks, which is a good chunk of money. They're going to be entitled to pension income, which is amazing, of $6,000 a month. They probably need another $2,000 or so a month from their to live on comfortably. But then there's this extra wrinkle, which is they own not one but two homes, and not two homes in different places, but two homes next door to each other. So, which is great because when Mark and I come to visit, we've got a place to stay, and you'll teach us how to blow glass, right, Ken?
Absolutely.
How hard could that be? It seems terrifying to me. You got like a fire and flame and horror. Anyway, so these two homes, each worth about $650,000. The primary residence has this cheap mortgage, $225,000 outstanding at 3.25%. Second home that you're renovating. When's that renovation going to be done, guys?
Well, that's a good question. We're not even sure ourselves yet at the moment.
Okay. About $118,000 it's outstanding on a home equity line of credit. And so, all right, what I was saying before the break is this. So if you retire right now, you just don't have a ton of money to live on. So you're going to have to take money out of Sarah's 401k because she's already 59 and a half, and you're going to have to start paying tax on that. And you're going to need to pull money out, not a ton. Like you said, you only need an extra $2,000 a month. You just have to pay, you're going to have to pull more out of the 401k because you're going to have to pay tax on the 401k, right? So now, in order to generate the 25, there's no state income tax in the state of Washington, but you're still going to have to pull out, let's say, 40 to get to net you the 25 that you need. So that's not terrible, right? You could pull $40,000 out a year, probably for the next 5 or 6 years, and maybe you pull $250 out before the time you're collecting Social Security. You still have money, right? It's not a terrible thing. The big issue that I have is that if you were to pull so much money out of the 401k in order to pay down the mortgage debt, that would start to worry me because then you're sucking a lot of your liquidity out of your retirement income lives. I would almost say that if you really are going to keep both of these homes, and you say you want to, so I'm going to try to accommodate that, I think that you must keep the loans outstanding on them at least for a while, or you're going to have to say, okay, we're going to work longer, and then out of our money that we earn, our $170,000 or $180,000 a year, what we're going to do is we're going to work longer. We'll work as long as it takes to pay off the home equity line of credit. And that's it. Because I don't think you can do all of the things you want to do without draining the liquidity that I think you're going to need. Don't forget, as I said in the beginning, you guys are going to be retired hopefully for 30 years. And I want you to have that pool of money to draw upon.
Well, I guess our thinking is that, we're saying we have $1 million, but we have in our 401k, but we have enough. I guess our thinking is that our $1 million is our line in the sand, and we have enough over the $1 million in both of our 401ks where one of us could pay off the home equity line of credit and still have over $1 million. And then when I go to retire, I'd have enough money extra in my 401k to pay off the mortgage in the other house.
But why are you paying? But why pay off the mortgage anyway?
Well, then we could live off the $6,000 easily.
Less debt.
Yeah. Okay. I mean, if you've really got more like 1.1 or 1.2, is that what you're telling me? Okay, I got
Sarah
you.
has just over 1.1, and I have just over 1.2 in my.
So would you pull out this money as lump sums? Because then, okay. So let's see. Right now, you will pull this money out and pay 24% tax.
24%. Oh, yay.
Right, because you'd have to be pulling that money out, and that would be because you guys are you're mostly in the 22% tax bracket right now. You'd be pulling out the extra money as a lump sum, which would pop you into that. That money would be taxed at a 24% bracket, right?
Yes.
And there is no state income tax. So I think that, I don't know, there may be local tax. I'm not sure. I mean, here's what I think is the upside of doing it. You have peace of mind. Here's the downside. You lose some of your liquidity. It depends how much, like to me, liquidity is everything in retirement. But if you can have peace of mind with $2 million, in that 401k without having those mortgages, the reality is that probably over the next 20 years, the money that is invested in the 401k, even in a very boring balanced portfolio, will make you more money than the mortgages are going to cost you. Okay, that's the probability.
Right.
It's not the
That's
guarantee.
kind of what I was
right?
thinking too. That
So it's not the guarantee. It's the probability. But
right.
your peace of mind, and you've worked hard, may be worth it to you. So
Right.
I think that here's what I'm going to come down and say, if that's something that really is going to make your retirement that much more peaceful, and you really have more than $1 million, it's more like one. But that you really kind of sounds to me like you have more like 2.4 million right now, or 2.3, and you want to take the 300 and pay off the debt. It's not the worst thing in the world.
Right.
I would prefer it be a slow and steady, but the other piece of this is that you just don't have a lot of money outside of retirement assets. And so even if you do that, I almost would prefer that, one of you guys works a little bit longer just to build up some of the cash outside of retirement assets, because all that money is going to be taxable to you. I don't know what the tax rates are going to be going forward. So
Right. And I'd be willing to do that.
Really?
Work a little bit longer.
Sarah would totally be willing to have you do that.
Yes, I'm sure she.
Yes, she totally would.
Trust me, I want her out. I want her free.
You want one of you being free. Wow, you're so altruistic. I think you can do it. I'm going back on my original. I think now, as you tell me a little bit more, you could do it. It's not ideal. You're so young.
Sure.
And I guess that plan B, another thing just to keep in your back pocket, you could fire sell one of these houses. You live in a good market. If you said,
yes,
we've
been very fortunate with that.
Right? So you could say that, hey, Jill, plan B is that things are, tax law changes, something goes awry. One of those houses has to be plan B. In the back of your head, that should be your break the glass scenario, right?
We could sell one of the houses. I mean, it would. I think we both be kind of psychologically crushed about doing it.
Oh my God! Come on! Jeez, psychologically, let's get. You could do it. All right.
Yes.
Don't be psychologically crushed about that. Here's what you're going to be psychologically crushed about is that if, God forbid, something happens later in life, and it's an illness, or you need help, or you need care, whatever, anything like that, you will not be psychologically crushed about pulling the trigger and selling that house. So, okay. Ken, you're going to keep working. Sarah's going to retire. You're going to take some of the money. You're going to pay off these loans. Go easy. Don't put yourself above that 24% bracket. Remember, that bracket for this year goes all the way up to $326,600. So good luck. I look forward to our glass blowing lessons. Mark and I are booking our tickets. Oh, and by the way, guess what? I'm wearing a baseball cap. I'm wearing my Cairo Radio baseball cap right now in honor of you guys. All right, good luck. Thanks for calling us, and we'll talk to you soon. Keep us posted. It's Jill on Money, and when we return, more of your questions. We'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
Okay, we are back. It's Jill on Money, leap year edition. Mark just loves the whole leap year thing. It's too bad that the kid wasn't born in leap year. That would have been fabulous. There must be some sort of special prize to be born on leap year. We'll have to figure that out. Mark, let's do some research on that. Okay, ladies and gentlemen, we have been getting so many questions around tax time, but also about not just taxes, but the Secure Act. Remember, the Secure Act passed right before the end of 2019. And Mark will be sure to have links to the Secure Act. Maybe we should put that Secure Act post in the resource section, Mark, just while it's still pretty new. for the first 6 months of the year or something. Maybe we'll do that. All right. So I'm going to try to answer some Secure Act questions right now. Barry writes that my son and daughter both inherited a non-spousal traditional and Roth IRA from my wife, who passed away in 2011. They have been receiving required minimum distributions each year from the traditional and Roth IRAs based on their life expectancy. It sounded like the Secure Act did away with these stretch required minimum distributions. What will happen in their situation? Hey, here's a good news, because your kids are grandfathered into the old rules. So if the person who passed along that IRA died before the December 31st of 2019, then the old rules apply. So they're in good shape, no problem. And for inherited spousal IDs, there are absolutely no changes to the rules. So that's good. One other bit here is that required minimum distributions are now moved to age 72. And so Barry asked whether, does that mean that he gets to wait until 72 because the Secure Act changed, or is it the year in which his wife would have turned 70 and a half? I'm not sure I know the answer to that. So what I would do is I would call the custodian who holds the account of the spousal IRA and ask that question. I'm inclined to think that 72, because it became your IRA, that I'm inclined to think that essentially the 72 would apply. But again, I'm not 100% sure. Call the custodian. You can find out. All right. Does that make sense? Whew. Okay. Here's another Secure Act from Frank. Same deal here. Frank inherited a 401k from his brother last year, and the brother had not begun making distributions. So yes, you can still use the French option, the stretch option. So stretch IRA, again, if the person died in 2019, that's the rule. All right, here's one interesting one. This is from Margaret, who also asked about the Secure Act. The feature of the Secure Act is that you can now tap 529 plans to help pay off student loan debt. But this is a little bit slightly different, because Margaret is the grandparent. Her grandson's a senior in college. And so this is his last semester, right? His parents took out a student loan for the final semester. And Margaret has a 529 plan, and the grandson is the beneficiary. I'm not sure why they didn't use the money in the 529 plan for the last semester. The question, can I use the money to pay off his student loan, which is now being paid for by the parents? I think that you can, but here's the deal. I think you should also call the 529 plan, because I bet there's paperwork where they have to make sure that the student loan is for the education of the beneficiary of the 529 plan. So that would be my guess. Also, for other folks who are thinking about using this feature of the 529, what's interesting to me is this could be a way where maybe you have a child take on the loan, the child, not the parents, and then the 529 assets can be used later in order by the grandparents to pay off that loan, so it doesn't mess up your FAFSA application. Because sometimes when you take a distribution from the 529 plan, it can mess up your financial aid. So I would be careful about that. And whenever you have a question, go right back to the one who holds the account, in your case, T. Rowe Price, which manages the Maryland 529 plan. Okay, question is, under the Secure Act, required minimum distributions now move from age 70 and a half to 72. How does this affect the calculations for required minimum distributions, I think probably by a very small amount. Those tables will be obviously available probably sooner rather than later. And you can easily go straight to the organization that holds your account from which you're going to take the required distribution, and they will be able to give that to you. Remember, they have to do that, right? So that's an important piece of information that you should know. Okay, what else do we have? One more question here about the Secure Act. Jim's brother passed away in 2007. He wants to know, is the new law going to affect him? No. Again, you're grandfathered in. So, but listen, the more questions about this, the better. I don't want you to get freaked out about this. So if you can, if you do have a question, please, please, please make sure you send it to us. It's very important. Okay. Here's one last one here from Stephen, who is 72, working full time. He says the 401k is available. Can I contribute to an IRA and a 401k? Yeah, but I'm not sure you need to. In some respects, it might be better for you to, I don't know what else is in your life, whether other money you have, but I'm not sure what you're deferring the money for, unless, I don't even know. You might as well just pay the tax and have it, because tax rates are pretty low. It depends on how much you make, but I could be wrong. You can school me on that, but I'm thinking that maybe you could do it, but I'm not sure that you need to do it. How about that? Fair enough? Good. All right. There's a lot of Secure Act in one little segment, right? Hey, don't forget the paperback version of my book, The Dumb Things Smart People Do With Their Money, 13 Ways to Right Your Financial Wrongs. It's out in paperback. You can get it by going to our website, jillonmoney.com. All you have to do is click on the link that says The Book. All right. We will be back in just a moment with more of your fantastic questions.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money. If you've got a financial question, we want to hear from you. Ask Jill at jillonmoney.com. That is our email address. If you're on the website, jillonmoney.com, you will see that there is a beautiful contact button in the upper right corner of the site. Click on it. Send us your question. Let us know what's on your mind. I lied. I've got one more Secure Act question, and probably about 1,000 more after this, but at least for maybe this segment. We'll move on, I promise. This is from Mary, who says she started a 529 plan with herself as the beneficiary about 10 years ago. This is so cool. In the event that I might need or want more education someday, or if I were to have a child. Fast forward to now. Ready? She's got $7,000 in the account. She contributes through payroll deduction. She has no plans to go back to school. She writes, I am 40, married, no kids. I have about $43,000 left in school loans. My husband has $18,000. He's considering returning to college or pursuing an apprenticeship in the next few years. We've got no 529 set up for him. Does he really need to go back to school? Because I just want to pause on that moment on that question for a moment, because if he's not going to appreciably change his income, I would not be piling on more debt right now. 43 grand is a lot that you have in your own name, 18 in his name. I might take a breather here, but here's the question. Can I really use my own 529 plans to pay off my student loans up to $10,000? Yes, you can. Can I treat my 529 as an emergency fund to cover my student loan payments if I were to lose my job? Should I pay down $7,000 of my loans now or wait till the balance is lower? No, pay down the highest interest student loan debt right now. That's it. That's what you should do. And don't open up a 529 for your husband, but do try to consider whether or not this really makes sense for him to be going back to school, given your situation. Because I would worry that perhaps that may not be the smartest thing. Okay? Okay, here is from Tim, who converted approximately $170,000 of an IRA to a Roth IRA. He did it on December 30th. He says, I would have done more, but I didn't want to exceed my income tax bracket of 24%. It's going to take me at least 3 years to convert all of my traditional IRA. I originally thought I had till April 15th of the following year to do the conversion. When I read it had to be done at the end of the year, I hurriedly got it done. Okay, here we go. Now that the new year has started, I was going to move $7,000 over to my Roth from my individual account as I do every year. It occurred to me that I may not be eligible to contribute to a Roth and that the $7,000 I contributed in 2019 may not be eligible because of my conversion. Obviously, I will have to consult with my accountant before my taxes are complete. Could you confirm my suspicions? I would have a better answer from my accountant. Can you give me your opinion on whether it makes sense to convert? I know every situation is different and future tax rates are just a guess. My thinking is rates are going to rise. I agree with you. And many tax experts also and financial planners also agree with you. So here's the question. Let's see more. Let's see. I'll have $70,000 in pension income at age 60 if I continue working, and I'm going to have more money from rental homes. So he's going to have income. I think it's great to do the conversion. I actually, let me think about this. Mark, you can weigh in if you want. I think he can do the 7,000. I think that he can. So I think that if you converted 170,000 last year, and you now say, I was going to move $7,000 over to my Roth from my individual account as I do every year, you're making a new contribution into the Roth. I think you can do that. I don't think that that's a problem. I don't think that the conversion has anything to do with it. If Mark, am I wrong or do you think I'm right? I think I'm right. I think the conversion is separate from the contribution. Two different things. So I think you're all set. I'm good with that. Check with your accountant. Let us know if that's the answer is different. I love the idea of the conversion, guys. I really do. It's so smart. It's really important also that you remember the reason you're doing this is to have some security about what exactly your tax liability is. That's one of the best parts of it. To know what you're facing. Amazing. Really amazing. Okay, hold on a second. Here is a question from Gregory. I heard you mention bundling itemized deductions. How do I get data explaining that? Oh, this is easy. If you're claiming the standard deduction, okay, the way you think about bundling, Gregory, is to simply take a lot of those items that would qualify you for an itemized deduction and bundle them into 1 year. Meaning, let's say you want to give a bunch of charitable gifts. And you may say, oh, this is a year where I'll put them all together. I'll make all my gifts this 1 year, and then I can itemize. If you look at, Mark, do we have where do I talk about bundling? Is that under, did I do that in the tax article this year, or did I do it under the tax changes? I think I did it in the tax article for this year. Did I post that yet? Did I send it to you? I'll send it to you. But it's very easy to do. It's just simply taking the approach that you want to try to itemize in a given year and take all of the deductions that would qualify for an itemized deduction. Maybe it's medical, maybe it's charitable, that might get you over that threshold for the standard deduction. So that's what bundling is all about. It sounds more confusing than it is. It's actually fairly straightforward, which is always odd when it comes to something like taxes. All right. You're listening to Jill on Money. Hey, during the break, hop on to the website, jillonmoney.com. Guess what you can do there? You can subscribe to our sister broadcast. It's a podcast called Jill on Money. And you can do it right from our website. So check it out. Jill on Money is our podcast. Same name as the radio show. Slightly different. Check it out. All right, we'll be right back. You're back. It's Jill on Money. Before we finish up this hour, just want to remind you we're broadcasting live from the Capital One studios. Capital One, what's in your wallet? All right. Here's a question that got Mark and my attention because we didn't know the answer to it, so we did look it up. It's from Bob, who asks, about his grandson. He says, my college grandson wants to begin a Roth IRA. He said his summer pay was $3,000, which all was from a stipend he received doing volunteer type work. How much of this can he put into a new Roth IRA? You ready for this? 0. Because a stipend is not actually considered earned income. Oh, I'm sorry. Well, maybe next year. So you have to have earned income to contribute to a Roth unless you are a spouse. A non-working spouse can put money in, but that's it. Sorry. Okay. Chris says, I have some matured savings bonds. I'm wondering, is there an option to roll the proceeds into another type of government saving option that would allow for deferral of interest gained until that option was cashed in? Is that possible? Can matured bonds be given to charities prior to cashing in to avoid having to claim the interest? The answer on that is definitely no. You can't do that. And I'm wondering why we want to actually do that. I'm thinking, I don't know how much you have. Chris, I'd love to hear more about this, but I'm in the mode where I think because whatever you roll, even if you could defer the tax, whatever you roll into, you're not going to get a ton of interest just because interest rates are so low. And so I'm thinking that maybe it would behoove you to essentially suck it up, pay the tax at this rate, and carry on. I don't know. I'm thinking double E bonds. Maybe they were yielding good interest when you first bought them, but it may be worth it for you to really consider paying the tax today and moving on. Never know what tax rates are going to do in the future, right? So that's something to consider. Okay, that is it. That is our first hour in the can. When we return, we're going to get back to more of your questions. During the break, why don't you hop onto the website, JillOnMoney.com, and check out the resource tab. It's excellent. Mark works very hard on that. Okay, we'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. It's hour number 2, and it's Leap Year Weekend. Mark, if you were born on February 29th, when would you celebrate your birthday? February 28th or March 1st? I know, it's a great question. I have tons of great questions. Oh, that's what my girl said. That's exactly what she said. Nah, I'll tell you. I don't know. I like March 1st. I feel like it's like new month, not a leftover kind of thing. Anyway, happy leap year. Happy leap year to you all. Delighted that you're joining us. Remember, this is the program that takes the mystery out of your finances, and we ask other curious questions in life. We are broadcasting from the Policy Genius Studios. Policy Genius is the easy way to compare and buy insurance. Just go to policygenius.com. My nephew was very embarrassed that I called him out for not having renter's insurance on the air. And I told him that if you're going to mess up, you're not going to take notice of perhaps your auntie's book, The Dumb Things Smart People Do With Their Money, then you're going to get called out. All right, guys. So let's not bury the lead. We're very excited about this guest. It's a special leap year guest. Just kidding. It's not. But in studio, how lucky were we to have none other than the Charles Schwab. Chuck Schwab. He says, call me Chuck. Okay. He wrote a book called Invested, and it's just really an honor to be with somebody who has been part of a movement that has changed the financial services industry and leveled the playing field for ordinary investors. And that is exactly what Chuck Schwab did. So buckle up. This is going to be a great time. Check out this interview. It's Chuck Schwab here on the Jill on Money Show. We are delighted to have a special guest in studio, Chuck Schwab. He is the founder, former CEO. You have some sort of emeritus title now at Charles Schwab?
I'm a chairman. I'm the executive chairman.
That is a good role to have at your own company.
Tell me, I have a fantastic CEO who does all the heavy lifting, and I just come and show up for the board meetings.
Oh, that's
Very
great.
nice.
You've written a new book. It's called Invested. It's the story of your business life. So let me start with a question. That is, what is the best financial or career decision you've ever made?
Well, I think, of course, starting the company, having early passion about thinking that investors needed another kind of choice about investing. How do you go about it? The old traditional method of selling stocks through stock salesmen really ended up being really old-fashioned and very expensive and not really leading to the best outcome. So I started Charles Schwab Company with a whole different view and a passion.
And what was the view of the street or these big brokerage firms when you opened your doors almost 50 years ago?
I always thought that the traditional firms created products or created their ideas about how much money they could make off the product first. That was the first decision. I tried a completely different way to look at things. What would be the best thing for customers? What would they really like first? And if they liked it and we could offer it to them and they picked up on it, then we would continue doing it. But if it didn't happen, that was unsuccessful, they didn't like it, we would stop doing it. It had nothing to do about making money. It was all about making a great deal for our clients.
And so what led you to think about the customer first? I mean, you come from a different mold. You don't come from a big Wall Street family.
Right.
You come from lawyers, right?
Right. Father was a lawyer, grandfather, etc. So I always thought, well, what's fair for people? Could we get more people to invest? Because investing, I came to the conclusion early on, because I read a lot of biographies about very successful people in the economy. And it came to be that the people who did investing, most of which did it in stocks, some did it in real estate, but investing is really a very powerful thing that made people change their lives in terms of their wealth lives, their success life in business.
And yet, when you started this company in the 70s, the vast majority of Americans were able to claim that they were part of a pension. They didn't have to feel like they had to invest. So talk a little bit about how the world of investing changed with the advent of the 401k and that more people were just becoming, I guess, introduced to the concept of investing.
Well, all that did occur. The 401ks were introduced, but I think even more important, more powerful movement that was going, people were beginning to live longer. Social Security was sort of a wonderful thing in the 30s when it was introduced. Average man lived until 65. Now that's almost 20 years later now. If you get up to that age, it's usually 80, 85 of the average, and some are very lucky and can live beyond that. So the advance in medical science, all those things, and better living and thoughtful way to go about lifestyle and so forth, we're all getting the benefit of that, of longer lives. Hence, Social Security simply will not be enough to take care of our lives that the way we have been accustomed, our modern lives. And we like to travel, we like to see TV, we like to take vacations, you know it.
So when you started the company, talk about the beginning and when you felt like it's catching on. So if you're in the early 70s, you start this company, it's this crazy guy, Chuck. When did you feel like, okay, this is going to work?
Well, it happened. I started with 4 people with the concept of doing discounted commissions. That was a very simple kind of thing. And that was really started in 73. We began in a very rudimentary way to do that, and it got more and more perfected. And by 1975, the SEC and Congress changed the uniformity of commissions from something that had been in place for 200 years. They said, let's free it all up. It's free and open competition now, no more fixed rates. The next day, the newspaper had a couple articles about it. One was really important to me. Merrill Lynch raises the rates 3%. And I said, oh, my God, I have got a heck of a business. If I can just keep it together, keep our people motivated and so forth, raise enough money to build the capital of the company, I got a heck of a business.
And then what led you to think you should sell the business?
Well, it was all a part of raising capital. I didn't have access to Wall Street. They hated me because I was a competitor, and I was forming a strong competitive force. And so the last person they wanted to support was me,
Right.
which is, looking back, is pretty funny. But many of them wish they had now, because the stock price did really, really well over the next ensuing years. But at the very beginning, the money was a struggle, always trying to raise money, friends, relatives, and so forth. And that was not always completely successful, but we scraped along, and I convinced certain people that we had a great future, and maybe they ought to think about an investment in the company. So eventually we did get there, but always that pressure. And so when Bank of America came around to buy us, and they flashed a couple numbers in front of me, and I came from nothing. I said, "Oh my God, that's a heck of a lot of money. Maybe I should consider that, because it really improved my net worth, going from zero to
A lot.
20 million."
We'll get back to our interview with Charles Schwab, Chuck, that is, to you and me, in just a minute. During the break, if you don't want to make a dumb mistake with your financial life, go to our website, jillonmoney.com. You can sign up for our free weekly newsletter, and you can buy my book, which is now out in paperback. It's called The Dumb Things Smart People Do With Their Money, 13 Ways to Right Your Financial Wrongs. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money. And if you've got a question, we'd love to hear from you. Our email address is askjill@jillonmoney.com. Last weekend was the release of the annual Berkshire Hathaway letter. And I love Warren Buffett. I was thinking about Warren Buffett when he was talking about his record with acquisitions. And I thought about that as I thought about the next segment with Chuck Schwab. But here's this great quote. The Oracle of Omaha says, I've concluded that acquisitions are similar to marriage. They start, of course, with a joyful wedding, but then reality tends to diverge from pre-nuptial expectations. Well, that is exactly what happened when Chuck Schwab sold his company to the Bank of America. So as he tells this story, have that little Warren Buffett quote in the back of your mind, because it is really so true. Everyone goes into a marriage, everyone goes into an acquisition or any kind of merger with the greatest of expectations. Sometimes it doesn't work out as planned. Here's more of our interview with Chuck Schwab. What happened when they make this investment in you? Are you allowed to run Charles Schwab as a wholly owned sub, or did they try to integrate you?
No. That's I insisted upon. We kept our same auditors, our same attorneys, our same staff. I had a separate board, so we were completely sort of an independent subsidiary. But yes, they owned all our stock, so they could pull the switch on me if they wanted to at any particular time. But they didn't, and they let us flourish. And we grew from 1981 right on through to 1985. We kept compounding and compounding. So all the stuff we were doing at Schwab was fantastic. Our customers really loved us, and we did perform really well for the bank. But the bank fell into bad times.
Itself, the bank separate of you.
The parent company
Right.
fell into bad times. It had some bad loans to South America. Shippers in Greece were canceling on some of their debt, and they had lots of issues to deal with. So the bank fell in these bad times and started selling a few assets. They had to sell their building. They sold this thing. And then finally I said, why don't you sell my company back to me? And we eventually worked out that transaction.
And when did that happen?
That happened in 1987.
Oh, what a funny year to have something big happen.
Oh, yeah. That was, as I call it, the tsunami year. That was all kinds of things went on. So it's a very interesting thing in the book itself. Talks about these things. It was fun for me to go back and recast all the little elements that we had to go through, but it's a pretty exciting time.
exciting is not the word I would have used because I was a young pup trader on the floor of the Commodities Exchange. My father was a specialist on the floor of the American Stock Exchange. My uncle was a specialist on the floor of the New York Stock Exchange. So it was a dramatic time. That's what I would say.
Yeah.
And it was intense. You experienced that loss, that dramatic day. Do individuals who are trading at Schwab jump ship, or do they stand?
Well, for the most part, people stand. I mean, there's a fraction, might be 2 or 3% that sort of panic as such. But, experienced investors know markets do go down. And unfortunately, when they do go down, they go down much faster than they go up. And so recoveries always take a little bit more time than the actual drop. But the drop, for most of us, think it's an opportunity.
Oh, yeah.
You're buying things at incredible prices.
I love when people go nuts about when the market, like even this past summer, the market goes down. And I said, wait, you're buying into your 401k 6% cheaper than you did 6 weeks ago.
Yeah,
Be happy about that.
I mean, we all go to sales all over the world, but when stocks are on sales, it seems like people are more fearful.
How was the advent of online trading? What did that mean for your company?
Our efficiency of doing a trade has grown and grown and grown. So the cost of us doing a trade is very nominal, frankly. And so we reduced our prices all the way along for the last 20 years or so until we find, let's make trading just free.
Which is a mind-blowing concept. I'm so sad that my father's not alive to see this because I remember he used to say, we're on our way to zero. And people would be like, what are you, crazy, Albie? Like, you're not, zero? They got to make money, right?
Yeah,
There's no... So now you went from, was it $4.95 or probably
$4.95,
less?
$4.95.
But let's just call it
yeah.
$5 to trade. Now it goes to zero. And people are thinking, wait a minute. How are these guys making money?
Yeah.
What are they going to do to make up for that $5 that they're losing?
Well, there's a variety of ways. We have people who use us as an advisor, so we charge a small fee for doing that if you want an advised account. We have a bank, so we make some money on the interest rates between what interest rates are and what we pay our clients in terms of their deposit accounts. So there's always little ways to make money, but the most critical thing is to have customers. And have a lot of customers. And so we are very proud about the fact that we have almost $4 trillion, and I say that with a T, of client assets with us. And so given all that, we thought, well, why not? Let's deliver on to our clients a greater value, like zero, and so maybe we'll attract more customers.
What do you think about the advent of robo-advisors? You have a service through Charles Schwab where you can put your money into an account and basically take your risk profile and an algorithm's going to do the rest. What do you think of that?
Well, I think it's an incredibly efficient way for the average person doesn't have the time to be thinking about this stock or that stock and go through all the machinations of, the market's down, I should buy. We do it for you sort of automatically. We also do tax loss harvesting for you, meaning we sell the stocks that you might have had a little loss in the portfolio and garner the loss there to offset gains that you might have in your account. There's all kinds of things that we do automatically for people. That's really a simple way to sort of accumulate money over a long period of time.
So I guess the question is, if we watched you guys be the ones who broke through and pushed down trading costs to zero, could you ever see a time where advice pricing starts to drop in a similar way? I mean, now there's no guy sitting in a big fat Merrill Lynch office who really can get away with charging 8.25% for a mutual fund anymore, right?
No.
Okay. So I would presume that if Charles Schwab and Vanguard are both making the jump into advice, that is going to put price pressure downward. Do you agree with that?
Well, I think advice is a different thing. It's a complicated education process that goes on. And what has happened over the last bunch of years is schools don't do enough education about financial decision making. What should I do in my life and all of that. So I'm doing a lot of work in financial literacy, but I think people got to get a little bit informed. What are my requirements? What do I have to do in an overall sense so they're not just completely deaf and dumb about the whole thing. But they've got to put some time in to understand what it is to mean about saving. What am I trying to do? What's my goals? What's my opportunity?
Is the age of a managed mutual fund coming to an end?
Yes, I think so. Index funds have been so prominent in the last 10 years or so. They've grown to half of the new funds that are being built up today. And so it's very difficult to compete against an index fund because the costs are so much higher than an index fund. And so people want to go lower costs.
Do you think that there is a danger? There are some folks who are running around saying, hey, you know what? Everybody's in the index. Market goes down. Everyone's going to try to get out at the same time. It's going to be a cascading downside risk that we've now all piled into.
I don't think it's going to be any different than before. The market might drop on those really awful days, 10%, 15%, but you don't go in investing with the thought that it's going to be always an up day. There has to be many down days, too, along the way. That's what markets do. And you just have to have that pure and simple understanding markets are going to fluctuate.
You think that it was helpful that you were outside of like the New York Wall Street crowd, that you could think beyond the way business was done?
Oh, boy. When I think back of my background, there are many lucky moments, but I think the luck was for me that I was brought up on the West Coast, went to Stanford, and was around a lot of innovative type people. And so being on the West Coast, I wasn't part of Wall Street, and the old-fashioned ways of doing things. I could think about what would customers really like if we were to really develop something new and different.
We'll get back to our interview with Chuck Schwab. The book that he wrote is called Invested. During the break, why don't you hop onto our website, JillOnMoney.com, and there you can read my whole article about Warren Buffett. It's so great. Right there, easy. Just click on the Read tab. Okay, we'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. And whenever I have a legendary figure from Wall Street or from financial services, like I was able to have, I like to ask a question about what are people missing, right? So here's the end of our interview with Chuck Schwab. Yes, that's the guy, Chuck Schwab. His book is called Invested, and I wanted to understand from him what we as individuals tend to miss. I'm wondering for you what you feel like is misunderstood among the investment community about that this is not gambling. So what is it? How should we be thinking about this?
Well, I think there's a lot of misunderstandings about that. I mean, to me, the lottery is gambling. You go down and buy your ticket for $2 and forget about it. And later they whirl the pool and all of a sudden the winning number comes out. Investing, you're actually buying into. Think about the fact the first time you loved McDonald's hamburger, and then all of a sudden, gee, that's pretty interesting. Then you notice they build a second McDonald's hamburger, and then you build a third. Well, what does that really mean? It means they have more customers, and all of a sudden now they got 10,000 McDonald's, and so there's been an enormous accretion in value created by that company. That's called growth, and that's what you really can get in investing in great companies who have long history of serving customers. Therefore, customers pay good money for these things, and they build new outfits, new ideas, new innovation. That's what the crux of our great system here in America is all about, the innovation of new things and the creativity of mind to do that and allow us to do that. And by doing that, you're creating value, and that's investors who see that and identify those great growth opportunities. They're the successful investors.
We've been getting some questions. We take listeners, they call up and they want to ask us questions, and they'll often say things like, well, I want to get 100% out of the market, or I want to put all my money in. Can you talk a little bit about your experience with trying to time the market?
I've never been successful at it. Sometimes I think I can, and I've tried it many, many times, of course, when I think a bottom is hit. And I would say of the last 10 bottoms, I probably was correct maybe 1 out of the 10 times. And I was really happy about that when I encouraged my daughter, get in now. Today's the day. November 9th is the day to get in. We were actually skiing. I said, today's the day. We finished that after that morning of skiing. Said, looking at the reports today, this is the day. Take every penny you have in your pocketbook and put it in the market. But That doesn't happen every time.
So how do you look at the landscape now? You are in the Bay Area. There's a lot of innovation. We're hearing so much about many of these companies, these unicorns, who are remaining private for much longer than, say, folks who did in your time when you were before you went public. What's the upside and downside of being a public versus a private company? And is there any lesson that we should take in observing it?
Well, it's quite important. It's your access to capital. A company grows and needs capital, needs new capital. It just doesn't fall off of trees blindly. So you want to induce investors to see your opportunity and of course, buy your stock and so forth. It also allows those people who worked for you for a long period of time. I always like to participate, have every one of my employees participate in the upside of the company, that they are bought into the concept, the purpose of what we do as a company, and that's truly important to have that public available because, we're now a 40-year-old company. Many people are retiring, so why shouldn't they be able to take their stock and convert to cash and to fixed income that will support them through the retirement years?
Talk about the financial services landscape. Is there anything at this point in your career that keeps you up at night? Is there anything that you're worried about?
I think we're in fantastic shape. I think the advent of technology over the last 20 years, the internet has just brought all this flow of information to everyone. And so it's a great value. Financial services are a fantastic value for people, just like some other things in modern world today because the advent of technology.
What about these fintech companies that were really looking like hot, and then folks like Schwab jumped in and sort of ate their lunch? So if I had a fintech company 5 years ago that I thought was like, I'm on the way to getting $1 billion valuation, now you're in the business and Vanguard's in the business, is my fintech company now not worth quite as much?
Well, I don't know about that. I mean, we all look at great ideas, and so nobody in our business is above copying a great idea. And we see a great idea, or some people going to zero commissions, will say, or something else, a robo thing. It's a great idea, and customers really like it. Man, we're going to go right into it also.
How would you decide whether to buy that or to create it?
Well, it's very simple mathematics. How much will it cost you to build that capability? And if the little firm has some really outstanding ideas, patents and so forth, we'll try to buy them.
Do you have an insurance arm as part
We
of
have
Schwab?
some insurance. It's very modest in size. We've never been big advancers of insurance thing, and we think it's somewhat expensive. In fact, that may be another opportunity.
Yeah, well, I was thinking that it would be great if someone like, let's say, Chuck Schwab could say, yeah, the idea of an annuity is so appealing, right? It is, because in your brain, in your little, human brain, you say, yeah, I just want someone to pay me with my money. I want my own pension. But, of course, the insurance industry, I'll say you don't have to, is a bunch of pigs, and they charge too much to create that.
Oh, it's annuities are incredibly expensive. And not only that, then you get locked in. If something changes in your life, something dramatic happens, and you want to reverse it all. There are other ways, I think, to go about it that are similar, highly competitive, lower costs, and so we'll be helping our clients with those kinds of decisions.
I can't wait for that. Will you come back, or maybe your daughter will come back?
I promise.
All right.
I promise.
We started the interview, and I said, what was your best career or money decision? You said your best career decision was starting this company.
Right.
What was your worst?
Oh, my goodness. It's all outlined in my book. I've had many little...
Pick your worst.
Pick my worst. Well, that's part of life. You got to have some burn your fingers along the way, and then you don't do it again. And one that has to almost learn most of my things by personal experience. I try to read about it, but nothing better and more informative than doing it yourself.
Sad but true. The only way out is to go right through it, isn't
right
it?
Through it.
Thanks so much to Chuck Schwab for actually coming into the studio. What a pleasure. What a lovely gentleman. And go check out his book. It's called Invested. If you've got a financial question, we are ready to help you out. Send us an email. Ask Jill at jillonmoney.com. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
Man, do I love blowing through these emails. I like emptying out the email inbox. Mark, what about my whole theory that you should be the one reading the emails and I sit down and have someone feed me grape leaves, fan me, and answer them? What happened to that idea? I want Mark on. Now that Mark has passed the CFP exam, can I call you a CFP certificate now? Okay. So now that Mark is a CFP certificate, he passed the exam. I want his butt on the line with me. It'll be great. He's got a fantastic voice. Mark believes that we are the only host, producer, executive producer, that is, CFP duo. We might be. I think that's probably true. Congratulate Mark on passing the CFP. Send him an email. Ask Jill at jillonmoney.com. Ask Jill at jillonmoney.com. All right. Mark, by the way, I was thinking we should change our Peloton names to like Jill on Money 1 and 2. I don't know. We're very under the radar in the Peloton universe. All right. Robert wrote and says, I know that Fidelity Investments has an IRA fund that is set up so that any withdrawals will go tax-free into a charity of your choice. So all the increases you made over the years can now be taken out tax-free. Huh. Okay. First of all, that's not what Fidelity has. There's two different, I think you're confusing two things. So Fidelity has a charitable giving fund that you can use whereby you can put money from a taxable account into the Fidelity account. You can move the money over, and whatever you move over in your taxable account that goes into the charity, whatever securities, that amount would be kind of what you've been take as your charitable distribution for the year. And those funds don't have to be given out in the same calendar year. But so let's say Mark has $1 million in his investment account. He wants to take highly appreciated securities, move them into a Fidelity charitable account, and he's going to move $100,000 this year. He'll take a $100,000 charitable deduction in this calendar year 2020. But the money that's in that Fidelity fund does not have to be given out in the same calendar year. It can be given out whenever you want. So there's a way to actually bundle your deductions if you wanted to make a big chunk of a gift into it. The other thing that I think you're talking about is called a QCD. And that is a qualified charitable distribution, which you can use to satisfy your required minimum distribution from your IRA account, from any IRA, not just Fidelity. And the beauty of the QCD is that you can gift money to a charity directly from your IRA account, and then it goes straight to the organization. The organization doesn't have to pay tax due, and you're not going to get a charitable deduction for that, but you will never have gotten the money. So if you were supposed to take $10,000 as your required minimum distribution in 2020, and you say, I don't need the money, I'm going to divert it to the American Cancer Society, then the good news is you don't have to claim that $10,000 as part of your taxable income. So those are the sort of the two different things that I think you're talking about. If I've missed something, follow up, because I think that we might have conflated the two different issues there. This is from, let's see, Alan, who retired a few years ago. He's doing well financially. He has Medicare. He's got Social Security. And he's got he says there's an organization called the National Committee to Preserve Social Security. He says, I never heard of them before, but they've been sending me letters, flyers, asking me to donate to help preserve Medicare and Social Security. Okay. I don't know if it's a scam or not. Don't do this. There's absolutely nothing. There's no reason you need to do this. Social Security will be preserved. You don't have to contribute to an organization that's going to do that. Some politician eventually is going to actually realize, hey, all the people who have Social Security vote, so we're going to have to really take care of that. So, okay. That's something that you don't need to be putting away. Okay. Here we go. This is from Lindsay. Her mother-in-law passed away, and husband recently received a death benefit from her public school's retirement system. And Lindsay writes, it's essentially a 401k that accrued over her 30 years of teaching. I was looking for an idea of what would be the best thing to do with the money. We want to put it away for our daughter's college fund. The gross amount is $124,000. $121,000 is taxable. 3 options: direct rollover to an IRA, lump sum, or monthly annuity. All right, monthly annuity, no. I don't know. You don't mention how old you guys are, but the lump sum, you're going to have to pay tax on the whole thing. So it depends on your tax bracket, whether that's something you should actually think about doing. Otherwise, I would really try to just do a direct rollover to an IRA, leave it alone for yourselves, and then let's talk about an idea for how we can get your kid through school. Hopefully, I would love to follow up with you. I'd really want to hear more because I would love to leave this money alone. It would make a lot of sense to do so. Then I have a little retirement cushion. But I mean, maybe you've got way more money saved for retirement than you need. I don't know. So maybe a little bit more follow-up detail, but definitely not the monthly annuity. We got to really weigh which one of the other 2 options makes sense for you. All right? All right. Thank you for writing. And if you've got a question out there, send us an email. It's askjill@jillonmoney.com. If you're poking around the website, which I implore you to do, jillonmoney.com, all you have to do is hit the contact button. It's there for you. Okay. We will be right back. You're back. It's Jill on Money. We are broadcasting live from the Policy Genius Studios. Policy Genius is the easy way to compare and buy insurance. Just go to policygenius.com. All right, before we finish up, Kevin writes that his wife and he are retired. They both get full Social Security as well as postal pensions. Whew, baby. They've got thrift savings plan accounts, which they don't need to touch. Oh my God. Why didn't I work for the government? I love those TSPs. My wife is 65 this year, will be on Medicare. That's going to reduce the amount of money she receives from Social Security. We also will continue our Blue Cross Blue Shield as a supplement. My question: what should we do with our thrift savings plan? We still have our mortgage for another 5 years. Is there any way we could get a monthly stipend while the principal is tax protected and maybe gaining some interest? We'd like to start traveling, but we don't want to worry about regular incomes being impacted. Okay, first of all, don't think about the mortgage. That's going to get paid off. That's fine. It sounds like the thrift savings plan should be left as is. And the one thing to consider is that since you don't really need a ton of this money to grow, because you've got pensions, you've got Social Security, you may want to shift some of your allocation to make this a more conservative portfolio. So that would be more like the G fund, which is the government bond fund. Really, all you have to do is you can set it up. And I'm not sure exactly, but I'm pretty sure you could probably just set up an automatic monthly withdrawal. And what I would do is I would keep the year's worth of distributions or withdrawals. I would keep that in cash and replenish it every year. I also would stop doing any sort of dividend reinvesting or reinvesting in general, so you accumulate money in the cash account. But the TSP is a great plan. It's cheap. I'm not sure you need to do much more than kind of let it do what it's going to do. It sounds like you guys are in really good shape, so I certainly congratulate you on that. All right, that's it. That's the program. Thank you so much for listening. If you've got a question throughout the week, remember you can always send us an email. Our address, askjill@jillonmoney.com. We will check in with you in 7 days. See ya.